Here is a terrifying statistic. The average person will pay over $200,000 in interest payments over their lifetime. Mortgages, car loans, student debt, credit cards. That is an entire fortune vanishing into thin air. But here is the central paradox of modern finance. You work hard to save money. You put that money into a savings account where the bank pays you, if you're lucky, maybe 1% interest. Then, when you need to buy a car or a house, you go to that same bank and borrow money back, paying them 7%, 10%, or even 20% interest. Essentially, you are renting your own money back at a premium. Why do we accept this? Why do we let the middleman keep the profit? The answer seems obvious. Because I don't have enough cash right now. But what if there was a way to cut the bank out entirely? Today, we are dismantling the family bank strategy to see how you can stop leaking wealth and start recapturing it. To understand the family bank, we first have to understand why most families lose their money. There is a famous proverb, shirt sleeves to shirt sleeves in 3 generations. The first generation makes the money, the second spends it, and the third sees none of it. Wealth needs to be accessible, but it also needs to be protected. The obvious mechanism of a family bank is simple: intra-family lending. Usually, when family members lend money, it's a disaster. It feels like a gift. The borrowers say, a child buying a house feels no urgency to pay it back. Relationships get ruined, and the capital evaporates. The bank of mom and dad usually has a 0% repayment rate. Think of a traditional bank as a fortress. It has walls, guards, and strict rules. Think of a typical family loan as a picnic. It's open, messy, and food gets stolen by ants. The family bank strategy is building a fortress inside the picnic. At this obvious level, the family bank operates on a formal contract. You are not giving your child $30,000 for a car. You are acting like a bank. You draw up a promissory note. You set an interest rate, usually the lowest rate allowed by the IRS or tax authorities, known as the AFR. You set a repayment schedule. Instead of paying 8% to a commercial bank, the child pays 4% to the family bank. The child saves money, paying less interest. The parents earn money, getting 4% instead of the 0. 5% from a savings account. It's a win-win. But if we stop here, this is just a loan. It's not a system. To build true dynastic wealth, we need to go deeper. Now, let's escalate. A simple loan saves you a little money, but the hidden mechanism creates a perpetual motion machine for wealth. The secret isn't the loan itself. It is the recirculation of interest. In a regular scenario, when you pay interest to a bank, that money leaves your family forever. It pays for the banker's bonus. In a family bank, the interest paid by the borrower isn't income for the lender to spend on groceries. It is returned to the capital pool. Imagine the family bank is a bucket to 1. The child takes water out to build a business. 2, the child pours water back in, plus extra water interest. 3, the bucket is now fuller than when it started. 4, the next child can borrow even more. The wow factor, the plot twist, this is where it gets crazy. The family bank allows you to use the same dollar twice. This is the concept of velocity of money. Let's say the family has a trust fund. First, that money is invested in assets, stocks, earning 8%. Then, the family borrows against those assets to fund a mortgage for a family member at 4%. The family is earning appreciation on the original asset and earning interest on the loan. Furthermore, the family bank isn't just about money, it's a governance system. The bank can set conditions. You want a loan, you must present a business plan. You must maintain a certain GPA. You must attend financial literacy meetings. Suddenly, the money isn't making your children lazy, it's the tool forcing them to become responsible. You aren't just transferring wealth, you are transferring competence. So, let's put the pieces together. The family bank is not a physical building, it is a philosophy and a legal structure. It takes the obvious mechanism, lending money to those you trust, and fortifies it with the hidden mechanism, strict governance, and interest recycling. It turns the ruthless mathematics of compound interest from an enemy that enslaves you into a servant that empowers you. Instead of the bank using you to get rich, your family becomes the bank. This strategy requires something harder than just having money. It requires trust, communication, and financial education. It requires the older generation to let go of control and the younger generation to step up with maturity. But if you can pull it off, you break the cycle of debt slavery. You stop renting your life from financial institutions. You create a legacy that says, in this family, we back each other, we grow together, and we keep the fruits of our labor. That is true independence. Now, I know what you're thinking. This sounds great, but I don't have millions of dollars to start a bank. The truth is, you don't need millions. You just need the right mindset and the discipline to start small, even if it's just lending $1,000 properly. It starts with logic, not luck. If you want to understand the specific tools, like how to write a promissory note or how to set up a trust, let me know in the comments below, type deep dive, and I'll make a part 2. And if you want to master the game of money, hit that subscribe button and ring the bell. We are here to help you build your fortress. Thanks for watching, and see you in the next one.